If we're sitting at the closing table and the closing agent hands the client the proceeds check and they flip it over on the back and they endorse it and they slide it across the table to me, I would turn around and slide it back and I would say, you just blew up the exchange.
You blew it.
What's up, everybody? Welcome back to the Drury Outdoors 100% Wild podcast, powered by Buckland Funding, because we're in our 4th episode of the Cultivating Value series. And if you're interested in learning about getting a piece of dirt, how to manage it, and kind of all the stuff around that, this is your series.
Yeah, it's been fun too to go through this, and you know, honestly, we've gotten a lot of great feedback, and so I think we've struck kind of a nerve with people of you know, trying to help answer some questions that they've always had.
Yep.
And I know, you know, just personally and on Instagram and my DMs, I do get these questions like, hey, I'd love to hear you guys talking more about that. I'm in the same boat. I want to try to get my first piece of property or work towards it. Or, you know, I don't know if I should flip it or do a 1031 exchange or what that means. And so we have a guest on today that's an expert, whereas we were not, and we may have gave, you know, some terrible information based on the comments on episode 1 of this series. So we're going to give some great feedback for everybody today with an expert.
We got
so
a
let's
real
introduce
expert.
him.
Yeah, we got Joe Dierker. He's owner of First Harvest Land Exchange, and he's also going to be having walleye for dinner tonight. Joe, welcome aboard, buddy.
Wonderful. So you heard my conversation with my wife about walleye for dinner.
It's either that or it was a lucky guess, but walleye is a solid choice.
Sounded good.
There you go. That's what we like. Sounds great. Well, thank you very much, fellas. Really appreciate the opportunity to participate. And we're happy to have a conversation on 1031 exchanges. They're a really key part of the tax code. And especially when you deal with real estate, 1031 exchanges are a phenomenal tool. So we'll get into this here in a couple minutes and we'll talk through it. And we're happy to then follow up with any of the clients if they've got any questions. We'll make sure we get some contact information out there and let's rock and roll.
All right, good deal. Well, we appreciate you jumping on with us. And so right out of the gate, one of the things that, you know, I think I alluded to this in the first episode of this series, that all the big players and land that I've ever met and known, they have always used the 1031 exchange to their advantage. And I have flipped, I think, probably 5-ish farms now, and I've never done it once. And it's a little bit, there's kind of a couple of reasons why. One, I do like to be able to make a decision not based on urgency of some of the rules that go around the 1031 exchange. I like to just kind of, hey, if I got to sit on the cash for 6 months, I'm sitting on it. You know, if I got to sit on it for a year, I'll sit on it. But I know I am missing out on a huge tax advantage. So why don't you start from the beginning and explain what a 1031 is for everybody listening and watching at home here, and let's go from there.
Great lead in. So a 1031 exchange is truly a tax deferral strategy. And it sometimes gets a little bit of a misnomer because people will say, well, gosh, if I do a 1031 exchange, I'll never pay the tax. That's not exactly correct. So how a 1031 exchange works is once the transaction is complete and the documentation is in place and the relinquished property's been sold and the replacement property's been acquired, then you are entered into a tax deferral. And as long as you keep that tax deferral going, either by hanging on to the replacement property and utilizing it in your business or for investment purposes, or making a subsequent or a follow-up 1031 exchange, then that tax liability, while it never goes away, just sits out there and it's deferred. So it's I wanted just to say here for a minute, it's not paid. That's not really the greatest way to say it when you're dealing with the IRS. It's a lot better to say it's deferred. Where you would ultimately pay that tax would be For instance, if you rolled out of that replacement property a couple years down the road and you said, gosh, this is a great investment. Let's pay the tax. Let's go on. Let's be done with it. And at that point in time, you would pick up the tax liability, not only from the original 1031 exchange, but potentially any additional gain during that holding period once you acquired that replacement property.
So take us through I think one of the questions I always had is, okay, so if you're making, let's just start an example. When you bought your first property, you made $50,000, maybe it was 10 acres, whatever it may be. And, 25 years later, you flipped, 5-6 properties and you're making $250,000 and you're ready to get out of, so you're in a different tax bracket. You're married and maybe she makes, 60, 70 grand and you're in a totally different tax bracket and a different place in your life. At that point, when maybe it's retirement, whatever it is, and you're sitting on maybe your retirement nest egg and you're like, okay, the kids don't have any interest in the property and now I want to sell it and I want to use the funds and take hold of those funds. What happens in the tax bracket part of a 1031 exchange when you deferred these taxes for so long?
Yeah, that's a great question, Matt. So here's what happens. When you have long-term gain property, okay, so that's land that you've held for longer than a year. It's no different than having a stock portfolio that you held a portfolio of stocks for 1, 2, 3 years, whatever the case may be, and you decide to cash out. You are now subject to long-term capital gains tax liability. And long-term capital gains are taxed in either the 15% bracket or the 20% bracket at the federal level. Now, many times you will have state taxes. In Illinois, we've got a state tax for long-term capital gains. You also, if you were cashing out of an investment, you would be subject to the Affordable Care Act, or what is sometimes referred to as Obamacare tax as well. So even though when we have a discussion with clients and we say, hey, we're in the 15% bracket, I always tell clients, if you're in the 15% bracket, we're going to assume we're in the 20. And if we're in the 20% bracket, we're going to assume we're in the 25% bracket, just so that there's no surprises.
Someone's got to pay for all that free health care.
Yeah, I had no idea this wrapped into that somehow.
Yeah,
to Obamacare.
It was made part of the long-term gains in the tax code back when Obamacare was passed. 2008, 2010, somewhere back in there during President Obama's term, and at that point in time, it became part of the transactions that involved long-term capital gains. Now, short-term capital gains, where you would, for instance, if you use an example like today, you buy a farm, but 6 months later you can sell it. Okay, you're then subject to short-term or marginal tax rates, and that's just a completely different part of the tax code. And we don't have to worry so much about that with 1031 exchanges because almost every transaction is subject to long-term capital gains.
Well, let's dive into that a little further because some guys, they're flipping quicker. So their whole maybe their whole business plan is like, hey, I need to flip it quicker. So the interest, they might be buying a farm that they not necessarily can afford. So they're flipping quicker to get past the interest, eating them alive or eating up all the profit. So in that instance, how would a short-term capital gain be affected in a 1031 exchange? Let's say 20 years down the road, you had 2 farms out of 10 that were short-term capital gains. You got to go back to those rates at that time or rate short-term capital gain rates. How does that work, I guess?
Yeah. So what happens is if you have a transaction that is subject to short-term or marginal tax rates, you're going to pay the tax for the tax return for the year ending December 31st of the year you sold the property. Okay. And when you sell under marginal tax rate, it's no different, Matt, than like you described. Somebody that, for instance, is going to flip a house, is going to flip a farm, and you just have to remember that you will not utilize a 1031 exchange if that's your strategy. And every now and again, you'll see a client that has good intentions on going into a long-term capital gains tax deferral, but the opportunity presents itself to cash out. In that situation, they go ahead and they cash out, they pay the tax, and they go on.
Makes sense. So back to that original question, in the step-up basis where you've earned, over your life, and you're at retirement and you're at a whole different tax bracket, and you're wanting to cash out, does that affect, how's that 1031 looked at through the years? Is it they taking your current tax bracket, right? They're not taking what you were when you bought the first farm or any of the farms between farm 1 and farm 10. You're getting taxed at the very last tax bracket, right? For all of them?
Well, yes, to some degree, but here's what happens. When you do a 1031 exchange and it gets completed, well, let's just say it opens and closes in 2026. Okay. Now, when you file your 2026 tax return next spring, okay, you're going to report and you're going to tell the service about that transaction. There's a special tax form that goes in with your tax packet. It's called Form 8824 and whatnot. And that's where you're going to tell the service that, yes, we had this property. Yes, we sold it. Yes, we had gain. But, oh, by the way, we're deferring the tax liability. So the service will know 5, 6, 10 years down the road that tax deferral is sitting out there. Mm-hmm. And then when you do cash out, if you will, then your tax preparer, and I will share this with you, in almost every case when there's a 1031 exchange, a client needs to have a professional tax preparer. There's just too much that can go wrong with trying to file a tax return yourself. But at that point in time, because now the service knows that transaction is sitting out there, and then you report it as a sale, you pick up the cost basis from originally, that arrives at your gain, and that's what you pay tax on.
Are there any kind of limitations to how many 1031s you can have going? Like if someone has, 20 years of buying and flipping properties, is there any limits there?
Tim, there really is not, so long as you don't get yourself in a situation where you try to bring in a subsequent 1031 exchange on a previous transaction prior to the 12-month anniversary. Because one of the things you want to always try to remember is you want to be at least 12 months in between transactions to stay eligible for long-term capital gains tax treatment. If you inadvertently cash out early, albeit entering into another 1031 exchange, you just caused yourself to have a marginal tax rate, tax liability event. So very important is to keep a 1-year anniversary or greater between transactions.
I'd like to go back a little bit and talk about some of the rules around 1031 exchanges. And, so for instance, the property must be of equal or greater value, and explain that in great detail, and let's just dive in it from that perspective and start at the beginning there. And what would it actually qualify for this?
Yeah, that's a perfect place to jump into this. So what you just described is actually some language that's right out of the tax code. And what it refers to is for a client to have a fully tax deferred exchange where you're deferring all the tax liability, you must exchange for equal or greater in both value and equity. Now, the value part's really pretty simple. Okay. If you had a property that you sold for $1 million, we'll talk about the cost basis separately, and you bought back $1.2 million on a replacement property, you've met the criteria for equal or greater. The equity side gets a little bit harder to understand because what the service is basically looking at is they don't want you to cash out all or a portion of a tax deferred transaction without paying tax on it. So the best analogy that I use for my clients is we're going to do just like we described. We're going to sell for $1 million. We're going to buy back for $1.2 million. We're going to have to borrow some money because we got it equal or greater in value. Well, instead of borrowing $200,000, the difference between the selling and the buying points, we're going to borrow $300,000 and we're going to go pay off the brand new pickup truck. If we did that, that last $100,000 becomes taxable because the service says in the rules, you are allowed to have a 1031 exchange where you use exchange funds to pay off debt and put back new debt so long as it's tied to the transaction. It's got to be tied to the replacement property. That $100,000 that flew out of there to pay off the pickup truck was not part of the transaction, and hence it becomes taxable.
Well, even on that example, if this isn't your main business, right? If this isn't what you're doing, like this is a hobby, or side hustle or whatever, and it's not your daily business. Can you actually buy a vehicle and use that through this exchange, or does that matter? Because like if it's an LLC, I don't think you'd be able to buy the vehicle through that if it's not your daily business, right?
Mm-hmm. So there's a couple ways to answer your question. The first is with regards to a 1031 exchange. Okay. The 1031 exchanges work for investment property. Another way of describing that is real estate. Okay. But secondly, if you could buy that pickup truck, it's going to get a separate treatment on a different part of the tax return. It might be eligible for depreciation or accelerated write-off or whatnot, just depending upon the uses of it. But if it's just purely, hey, I'm going to go buy a pickup truck, I might use it to drive up to the farm on the weekends, it's probably not going to be something that you can take off the tax return.
Yeah. And when you talk about the equal or greater value, and so you say you had a farm, a recreational farm that you're buying, can you use and flip that into a rental home with a 1031 exchange as long as it's of equal or greater value?
The answer is yes, because what happens with the definition of investment property, which is critical, and it goes hand in hand with long-term capital gains. So the service says as long as that property is held for business or investment purposes, it is eligible for a 1031 exchange. Now, one of the things we run into all the time, and you guys, I'm sure, see this probably as much or more than I do, is so many of these good recreational farms, the best deer hunting farms, have been improved with a cabin. They've remodeled a house. They've got some sort of fixed investment improvement value on them. That can become a little bit problematic in a 1031 exchange. And then you have to get it outside of the exchange. The best way is to carve it off and literally in the same transaction, give the client or the buyer a separate deed just for the house, 1, 2, 3 acres, as the case may be. It's now outside of the exchange. Unfortunately, it's probably a taxable transaction. Okay. And where I'm going with this is in the tax code, there is an allowance by the service that a client can utilize a improvement on a recreational property or farm, as the case may be, for no more than 14 days in the previous 2 years or 14 days in the subsequent 2 years after the exchange. And that property can then be included, or that improvement can then be included in the 1031 exchange. Here's where the problem comes in. Many people exceed that 14-day threshold. For instance, they spend a couple weeks there in the summer, they're there for 2-3 weeks in the fall. And so now you've got to carve it out and you got to sell it separately. So to kind of come back around to the question the way you asked it, Matt, it is no problem to sell a farm and buy rental houses. You could buy commercial buildings. You could buy vacant land. You could buy a strip mall. There's a couple other investment vehicles that can be eligible as replacement properties as well. And we can get into that here separately. But by and large, as long as you're not buying a property that you're going to live in more than those 2 weeks out of the year. A good example is somebody sells their farm in Pike County and says, we're going to go buy a condo at Lake of the Ozarks. Can we do it? Well, the answer is, are you going to live in it? Well, sure, a couple months out of the year. Then the answer is no, it will not qualify.
Interesting.
So it's trying to draw a line between a recreational or investment property versus a primary residence.
Mm-hmm. Yeah. So what happens in the tax code is there is a special section called Section 121. Okay. And if you think about a primary residence that you might live in, okay, and if you can meet the requirements that you've resided in it 2 out of the last 5 years, then both you and your spouse are eligible for up to $250,000 of gain exclusion or tax-free gain. Okay. But that has to be a primary residence. Unfortunately, that same exclusion does not apply to a weekend residence, a summer or vacation home, or something like that. It only works for a primary residence. So when clients call us up, when we have that discussion with them, if we know that they're living in the house on the farm, if you will, we're going to steer them towards carving that house out and selling it under Section 121 because it's tax-free. Why would somebody want to be in a tax-deferred situation if they can be in a tax-free situation? So that's just all part of some of the early discussion that we have with clients when they reach out to us or we get introduced to them.
That's great, because I would have never guessed that if there was a residence on your property that you have those kind of strictures, like 14 days. Where'd that come from?
Random. Why would they want to make sure you're not using it for an investment property as as your own kind of playground almost?
Yeah, and I get it. I mean, what was it? Letitia James down in Georgia got pinched for getting a home loan for a secondary home that she said she was going to live in, but
as a primary residence, she marks it down as, right?
Yeah, and she was really like Airbnb-ing it or renting it out to a cousin. And so like she got tax advantages on the loan for primary residence, but it was essentially an investment property. Yeah.
So why don't you take us through next, like the identification process? So you have a farm, whatever, and you're in example there, you have a $1 million farm and you sell it. What are you doing? What's the next step? You got a contract down, you got a date that you're going to close, whatever it's, called April 1st is the date. Like, what do you have to do from that perspective, like from that time frame, to make sure you're staying within the 1031 guidelines?
Perfect segue. So what happens, Matt and Tim, is this. When a client knows that they're going to have a 1031 exchange transaction, the first thing that we recommend is let's get lines of communication going as early as possible, partly because there's so many questions that need to be answered. But here's kind of the mechanics of that transaction. So at the day of closing on the relinquished property, we would have already put together the exchange documentation. Client would have signed them. We would have already talked to the closing agent. There's certain customization that's made to a closing statement to reflect a 1031 exchange. And then you go in and you actually close. Now, here's the biggest deal breaker in a 1031 exchange. A client inadvertently has the proceeds at the closing table and then says, oh, I'm going to do a 1031 exchange. Can you just tell me how to get these to Joe? Well, by that point in time, it's too late. So what I was referring to is called constructive receipt of proceeds. And the best analogy for that is if we're sitting at the closing table and the closing agent hands the client the proceeds check and they flip it over on the back and they endorse it and they slide it across the table to me, I would turn around and slide it back and I would say, you just blew up the exchange.
You blew it.
Whoa.
Yeah, because constructive receipt, you directed what happened to the proceeds. So how you avoid that is the closing agent will wire transfer the proceeds directly to our bank in Quincy, Illinois. The proceeds go in the trust department for creditor protection. And then as long as we're in between that relinquished property closing and one or more replacement property closings, those funds will stay in the bank and they're available for reinvestment into that replacement property. By the same way that they come into the exchange escrow, they go back out. They're wire transfer.
And that process is a QI, is what you're talking about. Qualified Intermediary.
Intermediary, yes, sir. Yeah. Yeah. So if you read in the tax code how you make sure that you get the tax deferral for nearly every 1031 exchange, you must engage the services of a qualified intermediary. There's a few very limited examples where you can do what's called a simultaneous. Sometimes I refer to them as a pot exchange. Those would not necessarily have to use a QI or a qualified intermediary, but far and away the majority of the transactions utilize a QI.
Okay, so you went through that process. You got a QI. They are holding your money. You're at closing April 1st. Is that when the ticker starts, and how many days you have to identify a property from there?
So there's two important dates in the 1031 exchange that you absolutely have to meet, and unfortunately there are no extensions to these dates. Okay. So the first date is what's called the 45-day identification period. And how it works is it begins on the day after the closing of the relinquished property. So if you close on April 1st, like you've described, Matt, April 2nd is day 1, 2, 3, 4, 5 down the road. And without looking at a calendar, by roughly May 16th or so, you must have the identification process completed in order to protect the tax-deferred exchange. The second set of dates, which runs at the same time or concurrently with the 45-day identification period, is called the 180-day exchange period. And what has to be done by the 180th day, the 1031 exchange has to be completed. You have to have closed on the replacement property and everything's done. The money's moved, the deed's been transferred, and the transaction is completed. So, if you don't meet either of those two dates, then you likely are pushing yourself into a taxable situation.
So a couple questions for you there. Okay, on identified properties, how many properties do you have? Is there a limit? Is there a minimum or a maximum of the amount of properties that you have to identify? And what kind of price range do those properties need to be in if you just sold for $1 million?
So how that works is in the tax rules, a client, an exchange client or whatnot, can identify up to 3 properties regardless of value. So sell that $1 million property like you described, you might identify 3 properties worth $4, $5, $6 million. It does not matter. Okay. If you felt like, and this would come into play mostly with a larger transaction, if you felt like you needed to have the availability of identifying more than 3 properties, there is a couple of alternative identification rules you can use. the most common of the two is called the 200% replacement property rule. And that just says I can identify an unlimited number of replacement properties as long as they don't exceed 2 times the value of the relinquished property.
So $2 million in this instance.
Yes. Probably 95 for sure percentage of our transactions fall under the 3 property rule, or I can identify up to 3 properties regardless of value.
Huh.
I guess with the property having to be the same or greater value than the property that you're relinquishing, there's no room in there then to get a deal. Like maybe the property is worth 1.2, but you were able to get them down to 950. You're saying that wouldn't qualify for an exchange.
It actually does, Tim. So here's what you have, and let's go back for just a second to that earlier definition of for equal or greater in both value and equity. So because that definition points us to a fully tax deferred exchange, there is absolutely the ability to do what's called a partial tax deferred exchange. Now, partial tax deferred exchanges work great with a couple of caveats. So let's go back to your example you led to. We sold for $1 million. We bought back for $950. Will that work in an exchange? It will, so long as the cost basis of the relinquished property is less than $950,000. In most cases, it will be. Let's just say the cost basis was $500,000. Then you've got a good partial tax deferred exchange. There's a proration made of the gain. The largest percentage of it is deferred. A very small portion of it gets taxed with your 2026 tax return. Okay. Where you would run into a problem with a partial tax deferred exchange, and we'll stay with the same numbers, except instead of buying for $950, like you pointed out, Tim, the client says, well, I only want to buy $400,000 worth. I want to put the rest of the money in the bank. In that situation, there is really no tax deferral. And so we would recommend there, just pay the tax and go on, because you're going to go through the process of a tax deferred exchange. And then when you get ready to file your tax return, the tax professional is going to look at you and say, why'd you do a 1031 exchange? You had no tax deferral here. So partial tax deferred exchanges are fine. You just got to make sure that replacement property is above the cost basis of the relinquished property.
Yeah.
This is why I kind of feel like, remember that old farmer from Napoleon Dynamite?
Yeah.
Napoleon's ass, and the chickens have sharp talons. And the guy's like, I don't understand a word you just said.
Yeah.
It can be confusing. And I'll tell you, when we have a transaction that gets complicated, and sometimes they can get very complicated, we want to get that tax professional in the loop as soon as possible. And we've had conference calls with the tax preparer. We've kind of given the information on what we want the client to discuss with their tax preparer and let them report back to us, however it works. But the main thing is, you sure don't want to go through that whole process thinking that you've accomplished a tax deferral and then find out later that you didn't get the tax deferral because something went wrong with the transaction.
I mean, I can just imagine like sitting at a table at a bank and
imagine me sitting at a table at a bank going through this.
and then Joe having to slide this piece of paper back over to you and go,
you messed up.
You just blew this up.
Yeah, you just blew it up, buddy.
And there's just so much at stake there. And I get it, like pay now or pay later. It's really about timing.
The thing about it is, I think a lot of guys that do this think I'm not ever going to pay, because their plan would be to put it in a trust and then you can, gift it to your kids, or there's a whole different element of this which is, and Joe, stop me if I'm wrong on any of
Can I
that.
stop you?
Because I think I got us into trouble on episode 1 of this series.
Well, see, what happened was,
So, I mean, isn't that kind of like talk about step up basis and all that side of this? Because I think there's a whole element there like, hey, you're going to, not necessarily have to ever pay the taxes if you don't sell the final property, right?
Well, not necessarily. So here's what happens. And go back to what we talked about earlier when we said that as long as you hold that replacement property, the tax is deferred. And of course, we always have to put that little caveat out there that tax rules are made by Congress, and we don't know what Congress would do in the future. But at least today in the tax code, if a client successfully exchanged, bought that replacement property, got the tax deferral, and held that property until they passed, then while they won't get around estate taxes, they would get around capital gains tax because of what's called the automatic step up in basis. That's in the tax code. That's out there. And all it does is it says, okay, at your passing, which as we can imagine, the client isn't going to benefit from that because to get the step up in basis, they are deceased, but it's the heirs that would benefit from it. And they now have an appreciated piece of real estate with the cost basis at least stepped up to fair market value as a date of death. So there is a couple of different ways that you could. It's not correct to say never pay the tax. It's better to say utilize the tax code and keep it in a deferred state. That step up in basis is not a very pleasant thing to think about because it kind of means that one of us isn't going to be out there to benefit from it. But at least today you could literally avoid paying the tax.
I think we could spend a whole podcast on just that aspect of the step up basis and trusts and all that, which I know that's probably the trust side's not probably your expertise per se, but I mean, there's a lot to setting yourself up to be financially sound in these decisions. So decisions you're making when you're maybe 25 buying your first farm, and you're 65 or 75, and retiring and deciding what to do with it, or 85 and passing away and gifting it to your family. Like there's a lot that needs to be put in place to make sound business decisions around it, right?
Yeah, no, you're spot on, Matt. That's really great. So one way, and what kind of popped in my mind when I heard you say that, is that you really probably are going to want to have two different discussions. One with the tax preparer during the 1031 exchange, and then you're probably going to want to follow that up with a conversation with the estate planning attorney so that you can take advantage of all the tools that are out there in estate planning to either minimize or utilize the gift tax exclusions or transfer it without having to pay federal estate taxes. Some states, Illinois has an Illinois estate tax, which can be pretty onerous.
Shocking.
Probably depends on how much you love your kids also.
Well, sure. Yeah.
Right.
So some people may not have anything to do with their kids, and it's just like, hey, this is my retirement fund. I've done all this work, all these years and all this property flipping for one. This is my retirement fund. That is a reality for a lot of people. And so at that point, you are going to get the tax implication. Like once you sell the final property, if you're wanting to cash out, you're going to get taxed at your current tax rate, right?
Yeah. So what happens is when you sell that appreciated asset, it's going to be taxed at capital gains tax rate. So that's where the actual tax is calculated, but it flows through to the front page of the 1040 tax form. So yes, you're going to have significant tax liability in many cases.
Are there advantages in paying the tax? And so obviously this is your business. You're here to work on 1031 exchanges specifically. But is there ever a time where you look at a client and say, you know what, that you might be better off just paying the taxes each time, and and then when it's all said and done, you can cash out and you're done. You have this nest egg and can do whatever you want with it. Is there ever a time where it makes more sense to do that versus to always do the 1031 exchange and kind of kick the can down the road?
Yeah. I think probably a couple of scenarios there. The older a person is in their lifespan, the more the 1031 exchange would make sense, because they're pushing that tax liability down the road. And logically, when they pass, that tax is going to go away. So a younger client, if you will, may say, you know what, I've got this investment horizon of many, many years. I don't mind paying some tax now and just getting out from underneath the liability. The other scenario that can come into play on that is the dollar amount of the tax. If you were going to pay to have a 1031 exchange done and you're going to have extra closing costs related to that, and the amount of the tax that you were going to have was roughly equal to those extra expenses, don't do the 1031 exchange, just pay the tax and go on, get out from underneath it. Where you really see the 1031 exchanges work really well is when you have highly appreciated property. And so what's happening there is the client has use of the money rather than giving it to the government. And again, as long as they understand that at some point in time you're going to pay the piper, you would enter into a 1031 exchange and have more dollars to go into a replacement property or defer the tax liability anyhow down the road.
One of my buddies just entered into a private real estate deal. They sold their primary residence, private party. They did not involve a realtor, and found out after the fact that they left probably $130K on the table as a result. And
because they didn't get a realtor and they didn't go get what max value.
The comps were probably not what they should have been. And when they did finally start checking around, they found out that the houses around them were going for way more than what the asking price was. And I don't know, Joe, are people out there ever thinking about trying to do a 1031 on their own and DIY it and save a few bucks? Or is that just like, can't do it?
So most of the time you have to use the qualified intermediary, because the majority of exchanges are called either a deferred or a forward exchange. And so what is unique about a deferred or a forward exchange is there's a time interval between the relinquished property closing and the replacement property closing or purchase. Well, go back to our discussion way back about the check being slid across the table. If the client says, well, gosh, I'll just hold my money and I'll put it into that replacement property, then it's a taxable transaction. So from that standpoint, and Tim, I know you gave the example there where the clients didn't utilize a real estate broker or real estate professional. We see in almost every, I can't say in every case, but in a very high percentage of cases, the real estate professionals are involved in the transactions.
Yeah. They
know the market, and especially when you've got that limited time frame for reinvestment, it's really nice to have that real estate broker looking for replacement properties for you. We have a good client over across the river from Quincy, and he sold 2 relinquished properties, and he is really struggling to try to find eligible replacement properties. He's got a couple of them named now, but every time I talk to him, he's like, I really wish I didn't name those. I wish I could name something else. Well, unfortunately, one, he's out of time. He's past his 45 days, but he was trying to find properties on his own and they just weren't out there.
Inventory is slim.
It's very slim right now. And Matt, we hear that from all the real estate brokers we talk to, all of them. And it's tough right now.
You bring up a few kind of good points in there, and just maybe we want to pull that apart a little bit and dive into it. And so say you identified 3 properties and the 45 days is up and you don't close on any of those 3 properties. You can't go identify a new property. You can't, you have to close on one of those 3 properties, right?
Yeah, you're spot on. So let's kind of deep dive into that for just a minute, because this is a discussion that we have with a lot of clients. So once the relinquished property closing takes place, as we know, that's when the clock starts. And by close of business on the 45th day, a client has to have named properties that he would want to utilize as possible replacement properties. And I use the word possible because, number one, they do not have to be under contract. It's advisable to have them under contract simply so that they don't get away from them. But they could close on a replacement property in the 45 days. That's perfectly fine. But here's the key thing. If they go through those 45 days and they do not identify any replacement properties, they just say, you know what? We looked, we tried, we couldn't find them. Therefore, we're just going to call it good, pay the tax. Then on day 46, so long as there is no identified properties, the exchange will close out, client gets their money back. They're in a taxable situation, as we mentioned. Here's where they got to be careful. During those 45 days, they might identify 1, 2, or 3 properties. If they call me up the morning of the 46th day, having something identified at close of business the previous night, those funds have to stay in the exchange account until either they close on those identified properties and utilize the exchange funds, or the 180 days runs its course.
I was going to say, so it's tied up for another 180 days.
Additional 135 days because you're picking up the first 45 through the identification period. Yes, sir.
Yeah. And so if you don't like the property, that's what I'm saying. Like I have not done this, and that part of it has scared me because I don't want to get in a situation where I'm forced to buy a property. Like
that's crazy to me.
Because the inventory is not there right now. Then you really want to kick the can down the road on the taxes, but you may be forced into buying a property that you don't really love.
Like I'm thinking about getting divorced. I've got 3 ladies I'm thinking about jumping to next.
Yeah.
Hopefully one of them says yes.
Yeah.
And if they don't.
So, that scares me a little bit because I don't want to be forced into a situation where I'm buying a piece that then may be hard to sell down the road because it wasn't really the best property, or the best fit for me. Does that make sense?
Yeah, that's a great analogy. And I will tell you, through the years, we've had more than a handful of transactions for clients where they've literally said, this is not my dream farm, but I'm going to buy this with the idea that a year, 2 years down the road, we're going to go ahead and 1031 again. Maybe the inventory is a little better. Maybe interest rates have gone down. Maybe land prices have dropped a little bit to give them the opportunity to buy a few more acres. So,
or maybe it doubled.
Out of the question.
I said, or maybe it doubled in that time. That's the problem.
Yeah, that could be too.
Those land prices don't go down. They might stay flat for a little bit, but they don't go down.
They're pretty crazy right now. It's, it's really good on one hand, but it's really hard on the other because, like I said, guys that are looking for properties and they're just, the prices are just pretty darn robust right now.
Well, and unfortunately, people selling their farms think that their farms are worth.
I know what I got.
That every farm's worth high dollar, and it really isn't the case. So it may sit there, and it's a whole different discussion on. We should probably have an agent come in and talk about that. But then it sits there, and it's not selling, and you got to take the price down, and or you got to take it off the market altogether. And when you go back to resell it, then it's kind of already got a little bit of a
stank on it.
A little bit, And so all those agents are pretty savvy, and they know what land prices should be. And so as a person that owns a farm, you should really listen. There's a price that you want to get, but you also need to look at those comps and listen to your agent. If you want to actually sell it and move it, sometimes you're not going to get what you think you're going to get out of it.
Yeah. Well, we talked with our friends from Buckland Funding about getting pre-approved. So you can like roll right in, make an offer, and not be hampered by that, and just essentially be kind of first at the table. I wonder, Joe, is that if someone kind of figures out like I'm probably going to be in a 1031 scenario, is there a pre-approval process, like a way to kind of grease those skids before they get too far down the road?
So one of the things that we talk to clients about all the time is where are they at in the process of finding that replacement property. And so one of the things that you can do, because those two sets of dates are all driven by that closing date on the relinquished property. Mm-hmm. So for instance, if you're working with the buyer, but you don't have anything in mind yet of what you might want to acquire as a replacement property, perhaps you can make a 60-day close out there, for instance. That would give you an extra 30 days to look for that replacement property. The only thing you got to be very careful about, and we caution clients on this all the time because, and we have not talked about it yet today, but there's this option out there called a reverse 1031 exchange. Clients sometimes have to utilize a reverse exchange, which just means you're buying the replacement property before you're closing on the relinquished property. And so you want to be real careful that you don't inadvertently, while you're waiting for the closing on the relinquished, enter into a contract on the replacement and then find out that replacement property has to close before the closing on the relinquished property. If that's the case, you just pushed yourself into a reverse exchange situation. And as I always describe it, while reverse exchanges are very doable, they're very complicated and they're very expensive.
Oh, expensive because you got to take, someone like your services and pay them to kind of walk you through this process and do the paperwork, or what makes it expensive?
So you actually have another party that becomes part of the transaction. So by way of definition or explanation, in a forward exchange, they sometimes refer to them as a three-party exchange. You have a buyer, you have a seller, you have a qualified intermediary. Okay. When you have a reverse exchange, you have to bring in a fourth party called a qualified exchange accommodation title holder, or the QEAT. And that's a third party that is unrelated to the transaction that's going to temporarily hold title while the exchange is open. That's what keeps the tax deferral in place. Unfortunately, that comes at pretty significant expense, a lot more paperwork. The QEAT says, gosh, I want to be paid for taking the responsibility of holding this property. So it does add to the cost structure.
Interesting. You should talk about the aspect of, okay, with a QI, they're not just, you're paying them to hold that money and help with this process. Like, so if the 1031 exchange doesn't end up happening, you have trouble identifying your three properties, or for whatever reason you couldn't close in that 180 time frame, even if you had one identified, you get your money back. You go into a tax issue, right? Like where you're going to be taxed on the sale of the relinquished farm, but also the person that was the QI, you paid them for, you're paying them for a service there, right? No matter what happens.
Yeah. Yeah. So Matt, to kind of drill down into that just a minute, here's what happens. So most QIs do it this way. We do ourselves, is we are paid on the front end of the transaction. So on that relinquished property closing statement, there'll be a fee shown. Okay. And that fee covers, in our case, document preparation, we'll calendar dates, and we'll make sure that we're staying in communication with the client, although it ultimately has to be the client's responsibility to meet the 45-day window or the 180-day window. We have no problem calendaring those dates as long as that understanding is out there. We'll also coordinate with the closing agents. And then we have a practice here because we get a fair amount of our transactions closed within about a 75 to 100 mile radius around Pike County. We'll try to attend one or both of the closings at no charge to the client, as long as we can get it in the schedule and it's not too far to go. A client that's selling a farm down in Georgia probably doesn't want to pay to fly us down for the closing, but even somebody that's closing in Hannibal, Tim, we talked about where Hannibal's located, just across the river from us. We'll go to that closing and be right there at the closing table, and it doesn't cost the client a single penny.
Yeah, that's nice. And it's kind of just a comfort level. Cause I mean, it is, I mean, maybe it's not, but it seems like there are a lot of little caveats to this, or could be complications. And so basically you're paying someone like yourself to take care of all that. So you're legal, through the whole process, you're dotting your I's and crossing your T's, right?
Yeah. So one thing that we strongly encourage the clients is, if there is the need or the desire to involve either their tax professional or their attorney, please do so. And we'll coordinate, work with both of those parties. We have absolutely no problem with them. It's not uncommon to send exchange papers to the client's attorney ahead of closing just for their review. So it really makes it very nice. But you're exactly right. You've got to make sure that it's done right, because and the perfect analogy, Matt, for this is the example where the client calls up on Monday morning. He closed on the farm on Friday afternoon, sold the farm, and the closing agent referenced to him that, gosh, he ought to consider a 1031 exchange. Well, that's a little too late. Yeah. Because he's already got the money. Ideally, a minimum of 7 to 10 days before the closing is what we ask for, to get in touch with us and make those introductions, and we can have that discussion with the client and see if it's a good fit for them.
What's the craziest thing or scenario that's happened to you in a close or in one of these deals? Like something that, it's like, holy crap, I can't believe that just went down that way.
Oh, I can give you a great example. So this was a couple years ago, and I got a call from one of the local CPAs. And he said, hey, first we talked, he had some questions, and he said, I need you to call this client and talk to him. They had done a 1031 exchange. He was the tax preparer. They had used a different QI, a bank. And as we found out later, the bank really did not understand 1031 exchanges. And what had happened was the client sold the relinquished property. Of course, it had a cost basis attached to it, bought back the replacement property below cost basis. So he, for instance, sold for $200,000, had $100,000 cost basis, but bought back for $50,000, if you will. And then he was upset because he was like, well, how come I don't get the tax deferral? Because of the fact that he did not reinvest above cost basis. So while that's kind of just a one-off situation in many cases, it's a good example of why it's pretty important to have those discussions with the tax people or with the attorney or our office as much in advance as you can.
You've referenced the cost basis a few times. Explain that, for people at home, what exactly you're talking about that.
Because we already know what it is.
Exactly.
Yeah. So cost basis would, by the simplest explanation, be, here's what I paid for the farm. Okay. Now, when I put on my CPA hat, if you will, then cost basis is going to be referred to as adjusted cost basis, which takes into account either depreciation or depreciation recapture. Both of those can take place in 1031 exchanges. But for the majority of the conversations we have with clients, cost basis is the same as what I paid for the farm when I bought it.
Now, how does that come into play with a loan? If you have a loan for, whatever, if it was $1 million farm and you had a loan for 3/4 of that or half of it or whatever it may be, does that change the cost basis at all or affect it in any way, shape, or form?
So it generally will not impact the cost basis, but Matt, that's a great segue to one of the biggest issues that we will run into with clients nowadays. So what the service allows you to do is on the closing statement for the relinquished property, because you got to convey clear title, you are allowed to pay off the debt that might be out there on a piece of property with exchange funds. No problem. As long as that same level of debt or greater is put back on the replacement property. Now, that also brings into the second half of that definition from earlier about equal or greater for value and equity. So if you go back to my example of the pickup truck, yeah, you paid off a bunch of debt. You took back new debt. That part was fine. But it was that extra $100,000 in the new debt that got you into trouble because it went off the closing statement to be used to pay off a personal asset. So yes, and there is a lot of situations where debt is part of the 1031 exchange.
I would assume so. I mean, say you got a loan out for 100 or whatever the number is, 500,000. You're saying, or that was what the payoff was when you sold the original farm for $1 million. Okay, so part of the proceeds paid that $500,000 note off. You're saying you have to have in this new property that you identified, the loan has to be for at least $500,000 or more.
Correct.
Yeah.
Right.
So then, as you're flipping farms, you kind of get yourself into a man, I gotta take on more and more debt each time. Like for me personally, I'm trying to take on less debt each time. And that's the whole point of flipping is at one day I hope to have enough cash to pay for the farm. In a whole.
It's a big picture to me, and this is where I've always wondered, am I just a dummy and I can't figure this out? But
I think that a lot.
But capital gains in general, the general concept, it seems like you're penalized for making some good decisions and good moves.
We talk about it a lot internally. You are definitely penalized.
Yeah.
But that's part of it.
One thing you can always look at is you can look at it this way in a 1031 exchange. The service has no problem with you telling them that you're not going to pay the tax today because they know they're going to get the tax down the road. Mm-hmm. What they're not going to do is make it convenient for you. You got to, it's not quite putting a square peg in a round hole, but it's probably in some situations not too far off of that. So you do have to be careful with that. I will throw one other point out. So you talk about the debt that maybe you might or might not replace. So if you had that $500,000 of debt that got paid off on the relinquished closing statement, you only put back $300,000 of new debt. Then that other $200,000 is called mortgage boot, and mortgage boot is taxable. It's just like you took cash out of the transaction, got taxed on it.
Mortgage boot.
So mortgage boot.
So you get taxed on that $200,000 that
That's
you
correct.
Borrowed.
Yeah. Well, the reason why you're taxed on it is because you got to use exchange proceeds to pay it off.
Yeah,
that's why.
I mean, I 100% understand why people do this, and really smart, sharp guys do this and use it to their advantage. And there's a ton of ways that you can use it to your advantage. For just a young guy it scares me a little bit. I just don't mind paying the taxes, my one little farm at a time. And, it might be 30. Look, it's a lot, it might be 30 grand. It might be 50 grand, depending on your proceeds. But it's just I know the cash that I have left is my cash. And so there is something to be said for that too. But I know there's probably going to be a point in my life where it's like the farm's big enough or the deal's big enough where it's like, yeah, man, I need to really start thinking about the next level here in strategy and go into a 1031.
Yeah, I agree with you completely. And we're very fortunate. We had a lot of referrals. And so when we get those referrals, we want to have that conversation with the prospective client as early as we can. And Matt, just like you described, I mean, it may be a situation that we have a discussion and the client says, well, you know what? That's really great information, but thanks, but no thanks. I'm going to just pay the tax. Go on. Hey, that's perfectly fine. There's no problem with that.
Mm-hmm. Yeah. And like I said, probably every sharp business guy I know does 1031 exchanges. So that always makes me think like, man, what am I missing here? What am I missing? But I will say Terry has mentioned to me, which my father, he said, hey man, I did it. And I really dread the day that if I decide to sell this farm instead of, going into the trust or whatever, I dread the day of having to unwind 30 years or 40 years of 1031 exchanges that got me to this point, and
how many does he think?
I think he's got 3 different properties, but 2 of them, I think, if I recall, were over in Illinois. So that, and he's a Missouri resident. So that probably is going to add a little bit of complication or maybe a little bit of heartburn.
Heartburn's probably a little more accurate.
Yeah. And in Missouri, they got rid of the capital gains, by the way.
Correct. They did.
Governor Kehoe got rid of the capital gains. And
I'd like to say that we had a part in that.
Yeah. And so so there's that element of it. It's like, hey, what is it? Was it 3% or I forget 5%? What that rate was? I forget what it was, but hey, it's something you don't have to pay now.
Yeah.
And there's conspiracy theorists out there that I use for those listening. I use the air quotes that think that we're gonna someday get rid of all capital gains, like federal capital gains.
Oh yeah. Yeah.
And so it's like, hey, I'm going to do 1031 exchanges because at some point I may not have to pay a tax, and I think that's wishful thinking.
Yeah. And my response to that is, does the terminology $38 trillion in debt mean anything to you?
I think it's wishful thinking, but who knows? Weirder things have happened. But in the meantime, I'll take my kick in the pants and pay the taxes for now.
Sure.
And just be able to sleep okay at night, I think.
Yeah.
No, I concur completely.
So is there anything that we've missed? Joe, this has been super valuable. I really appreciate you taking us through this because I think there's a lot of people that will probably be giving you a phone call saying like, hey, this does fit what I'm trying to do. And this was great info, but is there anything we're missing?
No, I think I just kind of peeked down at my cheat sheet just to see which items we might not have hit. And we've really done a really good job of hitting the majority of the big picture items. Great questions and great lead in and whatnot. I think probably the biggest takeaway is that if you have a client that has an interest in a 1031 exchange, whether they reach out to us or whether they reach out to their own local 1031 exchange QI, doesn't really matter. Have that conversation as early in the process as possible, just so that you don't get in that situation where maybe you regret you did a 1031 exchange because you didn't need to, or you didn't understand the time frames and you got caught without proper identifications made or whatnot. So the research, the communication, all that part is really, really critical to a successful transaction.
Yeah. Yeah, that makes sense.
And going with someone who knows what they're doing and has done it for some time
makes all the difference.
Yeah, we've got a lot of years experience doing it, and we're very fortunate. We really are, and we get a lot of referrals, as I mentioned, from a lot of the big name real estate brokers, as well as some of the smaller regional firms. We get a lot of repeat customers. Folks that might call me up after an absence of 4, 5, 6 years, and they're like, "Hey, do you remember me?" And I'm like, "Absolutely, we do."
Nice.
And whatnot. So yeah, we're very fortunate with that standpoint.
Awesome. This segment of 100% Wild is brought to you by PH Outdoors. Check out the full line of the G Series and brand new M Series drills at phoutdoors.com.
We got a game here.
Ah, Joe,
Play
are
a
you
game?
prepared to
Would
play
you like to play a game?
Yeah, this is going to be. It's going to be a multiple choice. So it's a.
All right.
And
lay it on me.
usually several of the choices are terrible. So.
Okay.
Yeah, whoever comes up with these questions, excuse my language, is sometimes a little stinker.
Well, depending upon the answers, we might change that stinker to something else.
Yeah.
Okay. Which of the following is a key tax distinction regarding the purchase of land?
Okay.
Is it A, property taxes paid at closing are fully deductible in the year of the purchase? B, you can only depreciate the soil if you personally named every single earthworm on the property. The cost of land is generally not a depreciable asset for tax purposes. Or D, interest on a loan used to purchase land is always fully deductible as an investment expense.
So is it one answer or more than one answer?
Well, looking at it, I feel like there's more than one, but we got one. Is
Supposed to be just one answer.
Yeah. I will definitely say A for sure, and I'd try to argue for C also.
Yeah, C's what they gave us. So A, property taxes paid at closing are fully deductible in the year of the purchase. Well, and I kind of feel like, so D, interest on a loan used to purchase land is always fully deductible as an investment expense.
It can be. The reason why I kind of hesitate a little bit is because it's not uncommon to keep a transaction simple. A client will maybe, for instance, borrow against a securities portfolio or borrow against a different piece of property. And that can bring some complications into it. So I did listen to that answer, but I kind of shied away from it just simply because in practice there can be some complications with it.
Some technicalities.
And that old test taking strategy, if you see always in an answer, it's probably not.
Ah, yes.
Right,
yes, Tim.
So. Yeah, my answer key says C, but I wouldn't have been able to
tell us
even start with that question.
Well, okay, Tim, so
nice
this is all pretty foreign to you. What did you learn from today's topic?
I mean, just the amount of like restrictions around who a 1031, like the situation that a person has to be in, specifically having some properties. The fact you have to identify the properties is crazy to me.
I had someone identify my property, and as you noted, they didn't have to put any kind of contract down.
How did you find out?
And well, they were looking at it, and via an agent. It wasn't listed, but they were looking at it, and we had done some negotiation back and forth, and I didn't, we didn't come to an agreement on the price or whatever, and then that agent told me that they still listed it. I was like, they can do that? I was like, even though I didn't agree with where we ended up, he's like, yeah, they can list it as an option still. And I was like, without a contract? He's like, yep. I was like, that was news to me. I had not been through that process before. So that I felt was interesting.
Do you have to be notified that your property has been identified?
I was not. I mean, other than I knew the agent.
Just through the grapevine.
Yeah. So there's no requirement that you have permission or notification. But if you think about it this way, if you're going, especially if you're close to the 45-day window, and you're going to identify a property that maybe you haven't talked to the seller on or you don't have under contract, you've got significant risk out there, because once that 45-day window closes, if that property is identified, the only way you're going to get the use of those 1031 exchange funds is either returned to you at the end of the 180 days or reinvested into that replacement property. So as I always tell clients, it's perfectly fine to identify without a contract, but let's work like heck to get that under contract as quickly as we can.
Anybody
you don't have to close on it right away. Yeah.
Thinking the same. Yeah. I've got 15 properties.
It is interesting. I mean, that process would give me a little bit of heartburn, but I don't know. If I was in that 45 days and I just said, oh yeah, these are the 3 properties that I identified, and I don't have really a good verbal agreement on any of them, even a verbal agreement on any of them, that would spook me a little bit. Like, shit, man, I got to really work to make this happen.
Yeah.
Yeah, it can be a problem because, if you will, the worst scenario that can come out of that is you make those 3 identifications, if you will, even the afternoon of the 45th day. And anytime thereafter, you call me up and you say, well, you know what? I just talked to all 3 of those potential sellers and they all turned me down. Let's just close things out. We'll call her good. And I say, sure, we'll have your money at 135 days at the end of the 180-day exchange period.
Yeah.
That's not a lot of fun when people are looking at it like, I can put it on deposit. I could use it to pay down debt. I've got other things I want to do with it.
Just put it in a CD and earn some interest on it. You could do a bunch of different things. Go to pay for
your calf implants, and then the money's not there. You got to wait.
Right. So it's just, I don't know. But yeah, that's an interesting aspect of it. So, man, we really appreciate. Where can someone find you if they're looking for you? Where can they find you at online?
Yeah, so we have a website. It is www.fhlellc.biz, B-I-Z as in zebra. So First Harvest Land Exchange, LLC.biz. That will bring it up every time. My cell phone number, 217-248-1214, or an email, joe@fhlellc.biz. And we're always happy to take calls, chat with people. Even if they're just kicking the tires, that's okay. We don't mind that.
Yeah, you never know when there'll be a client down the road, and like you said, it might not be for them now, but that doesn't mean that'll be the case always.
Oh, Matt, you're spot on with that. I mean, we had one last week that up until Thursday, the client was absolutely positive he was going to do an exchange. And he talked to his tax person, and tax person says, you know what, just pay the tax and go on. You don't, you really don't need it. We got other expenses we can use. And so he shot me an email and he said, hey, I feel terrible, but we're going to not do the exchange. And I said, no problem. And his response back was, you'll absolutely be the first call I make on the next deal.
Awesome.
That works for me.
Yep.
Then you say, we'll see about that. And you hang up on it. You'll come crying back to me.
Tim, we try to be a little kinder than that.
He's not our customer service rep.
No, I just tell people, shut it down, restart it, quit your whining.
Yeah, Matt, maybe Tim needs to be in the collections department.
That's right. Yeah.
I can be crappy to people.
Yeah, that's his nature.
Yeah, very good. So.
Sweet. Well, hey, we have a little bit of feedback from last week's show with Ben Rising. People really listen, and I got a couple texts on some things that were said during that episode.
Yeah.
I'm not going to repeat.
Oh.
But if you want to go back in and listen.
Was it
deeply,
near the bare knuckle boxing?
It was, yep. Yeah, it was near there. But our buddy Tom texted me. He's like, I love Ben Rising. Great interview. You guys had some funny zingers. Matt said, we all think of loggers in a certain way. And Tim said, yes, like red flannel shirts. So Tom, thanks for listening.
Chainsaws.
That's another big. I still haven't gotten that call from Ben to join his crew.
Yeah,
I got my batteries charged up.
Just keep your batteries on your electric chainsaw.
Guess so.
Chainsaw.
Yeah, they're in my backpack.
As long as the trees are 3 to 5 inches in diameter, we're good to go.
Yeah, and I got a couple hours.
That's right.
Yeah, we should also say hey to Austin Madden. He's a rack packer. I saw him at the Eric Church show downtown St. Louis this past weekend. I'm a pretty fancy guy.
Yeah.
I was like this close to getting called up on stage to help with some of the
guitar work.
Yeah, and I know all the words.
Yeah.
So I'm good.
You and probably 50,000 people.
There were a lot of people there that seemed to be fans.
Yeah.
Interesting.
Awesome. Well, hey, if anybody wants to join the Rack Pack, all you got to do is go to Facebook, type in the search bar 100% Wild Rack Pack, and just follow along. You're part of the club, and we got a little over 3,000 members strong in there, and you get some behind the scenes insight. You get to post up your hero photos when you kill something, and get any kind of feedback from the rest of the Rack Packers if you need it. So
good time.
Yeah.
Good. Very good.
All right. Well, I think we covered it all, or pretty good basis anyways. And I really appreciate you joining us, Joe, and the insight mostly. So thank you again. And I think that's going to close it out for this week's show.
Yep. Thank me, everybody.
I want to real quick close out by saying thanks to Buckland Funding for coming aboard for this 4-part series. It's been fun, and I think our listeners and viewers got a lot out of it. And so, anyways, want to thank those guys. If you're looking to get into the farm, recreational ground, or heck, even just home loans or whatever, check out the guys over at Buckland Funding, and they've been great to work with. I'm sure just like Joe is, and I think you'll be happy. So give them a call or reach out to Sean Ryan, and we'll make sure we put the number and info down in the show notes here.
Yep. Enjoy those walleye fillets, Joe.
Excellent. Sounds good.
All right,
fellas, thank you very much. Appreciate the chance to get to chat with you, and we'll look forward to talking to any clients that reach out to us.
All right. Thank you, Joe. And until next time, peace out.
Deercast movement prediction and mapping tools combined with our exclusive virtual rain gauges gets you ahead of your game.
We're adding new videos every week, so make sure to click that subscribe button and check out all of our amazing content. This episode of DoD TV is brought to you by Deercast Maps, waypoints, weather, virtual rain gauges, and more. Every tool you need to get ahead of your game.